Picture this. You check your portfolio one morning and Bitcoin has dropped 20% overnight. Not because of any major news, market crash, or economic event, but because someone with a massive following posted a meme on social media. Sound familiar? If you've been in crypto for more than 5 minutes, you've probably lived through this exact scenario multiple times. Welcome to the wild west of digital assets, where fortunes are made and lost on the whims of internet celebrities, where projects with nothing more than a flashy website raise millions in funding, and where the fear of missing out drives more investment decisions than actual research. Today, we're diving deep into the uncomfortable truth about cryptocurrency markets. They're still painfully immature, and there are striking parallels to another famous bubble that might make you rethink everything you thought you knew about where crypto is headed. I'm going to walk you through exactly where cryptocurrency stands right now, why it feels so eerily similar to the dotcom bubble of the late 90s, and, most importantly, what needs to fundamentally change before digital assets can evolve into the mature, resilient financial system that early adopters envisioned. We'll explore the 5 critical issues that are holding the entire industry back, and why a painful correction might not just be inevitable, but actually necessary for crypto's long-term success. But first, let's set the stage with a question that might sting a little. When was the last time you made a crypto investment based on solid fundamentals rather than hype, social media buzz, or the fear that everyone else was getting rich without you? If you're being honest, the answer probably reveals more about the current state of the market than any price chart ever could. The cryptocurrency revolution promised to democratize finance, eliminate intermediaries, and give individuals true ownership over their digital assets. Bitcoin emerged from the aftermath of the 2008 financial crisis as a bold experiment in decentralized money. Ethereum introduced the concept of programmable money through smart contracts. And over the past decade, we've witnessed an explosion of innovation spanning decentralized finance, non-fungible tokens, and entirely new models of digital ownership. On paper, crypto appears to be thriving. Bitcoin trades on major exchanges alongside traditional assets. Ethereum processes billions of dollars in transactions daily. Major corporations hold cryptocurrency on their balance sheets. Governments are developing their own digital currencies. Millions of people worldwide now own some form of digital asset. The total market capitalization has reached staggering heights, and institutional investors who once dismissed crypto as a fad are now allocating significant portions of their portfolios to digital assets. But beneath this surface-level success lies a troubling reality that few want to acknowledge. The cryptocurrency market today operates more like a casino than a mature financial system. Prices swing wildly based on social media posts. Entire projects can explode in value or collapse to zero within weeks. Market sentiment consistently trumps technical merit, and compelling narratives often matter more than actual utility or adoption. This isn't the behavior of a mature asset class, it's the behavior of a speculative bubble. And if you think that sounds familiar, you're absolutely right. Cast your mind back to the late 1990s. The internet was clearly revolutionary technology with transformative potential. Everyone could see that digital communication, online commerce, and connected information systems would fundamentally change how the world operated. But understanding the technology's potential and properly valuing companies built on that technology turned out to be two very different things. During the dot-com boom, investors threw money at anything with a website and a business plan that mentioned the internet. Companies with no revenue, no clear path to profitability, and sometimes no actual product beyond a domain name raised enormous sums of venture capital. Valuations soared based on potential users, page views, and vague promises about capturing market share in the digital economy. The phrase eyeballs over earnings became a rallying cry for investors who believed traditional metrics no longer applied in the new economy. Sound familiar? Replace dot-com with blockchain, eyeballs with token holders, and page views with transaction volume. And you have a pretty accurate description of today's cryptocurrency market. Projects raise millions of dollars based on white papers that promise to revolutionize everything from supply chain management to social media, often without demonstrating any actual utility or sustainable business model. The dot-com crash of 2000 wiped out trillions of dollars in market value. Countless companies disappeared overnight. Many investors lost their life savings. But here's the crucial point. The crash didn't kill the internet. It matured it. The speculative excess was cleared away, capital allocation became more disciplined, and the companies that survived were forced to focus on creating real value rather than just telling compelling stories. Today, we live in a world transformed by that post-crash evolution. The infrastructure, applications, and business models that emerged from the ashes of the dot-com bubble created the connected digital economy we now take for granted. But that transformation required a painful reckoning with reality first. Cryptocurrency appears to be at the exact same inflection point. The technology is powerful and the vision is transformative, but the market structure remains immature. crowded with speculation, hype, and fundamentally misaligned incentives. And just like the internet bubble, a painful correction may not only be inevitable, but necessary for the technology to reach its true potential. One of the clearest indicators that crypto markets haven't matured is their extreme vulnerability to influential individuals. In healthy, mature markets, prices move based on fundamental factors: adoption rates, revenue growth, regulatory changes, macroeconomic conditions, and shifts in supply and demand dynamics. Asset values reflect the underlying utility and future cash flow potential of the investments. In cryptocurrency markets, prices can move 20, 30, even 50% based on a single tweet from the right person. This isn't normal volatility driven by new information or changing fundamentals. This is structural weakness that reveals how shallow and irrational the market remains. When one individual can send an entire market soaring or crashing with a few carefully chosen words, it exposes several critical problems. First, it shows that the market lacks sufficient depth and liquidity to absorb noise without extreme reactions. Second, it reveals that most participants are reacting emotionally rather than analytically. And third, it demonstrates that speculation rather than utility drives most of the trading activity. This level of susceptibility to individual influence creates an environment where markets can be manipulated either intentionally or unintentionally. It also makes cryptocurrency an unreliable store of value and an unstable medium for long-term capital allocation. Institutional investors and conservative market participants simply cannot build portfolios around assets that can be dramatically moved by social media posts until crypto markets become deep enough, liquid enough, and rational enough to resist this kind of manipulation. Widespread adoption as a serious financial instrument will remain limited. The technology might be revolutionary, but the market structure is still amateur hour. Speculation itself isn't inherently problematic. Every emerging technology experiences speculative cycles as investors try to identify which innovations will succeed and which will fail. Speculation can provide early-stage funding for promising projects and help allocate capital toward the most promising opportunities. The problem arises when speculation becomes the dominant force rather than a secondary one. In today's cryptocurrency market, the vast majority of participants aren't actually using the technology they're investing in. They're not sending payments through Bitcoin, executing smart contracts on Ethereum, or participating in decentralized autonomous organizations. They're buying tokens with the sole expectation that someone else will pay more for them later. This creates a dangerous feedback loop that disconnects price from value. Here's how it works. Initial hype around a new project or technology attracts speculative investors looking for quick profits. Their buying activity drives prices up, which generates more media attention and social media buzz. Higher prices and increased visibility attract even more speculators who don't want to miss out on potential gains. Eventually, the gap between price and actual utility becomes so wide that reality reasserts itself, often violently. During this cycle, the speculators who entered early might make substantial profits, but those who arrived late often suffer devastating losses. More importantly, the entire process diverts attention and capital away from projects that are actually building useful infrastructure or applications. A mature market requires a foundation of users who value the technology for its utility, not just its investment potential. Until cryptocurrency markets develop this foundation, they'll remain vulnerable to boom and bust cycles driven more by psychology than fundamentals. Fear of missing out has become one of the most destructive forces in cryptocurrency markets. FOMO drives uninformed investors to make irrational decisions, allocating far too much capital to investments they don't understand. Social media amplifies this phenomenon by creating echo chambers where success stories are constantly shared while failures are quietly ignored. When FOMO dominates investment decisions, several problematic things happen. First, due diligence gets skipped in the rush to get in early. Investors skim white papers rather than studying them carefully, ignore red flags, and trust promises without verification. Second, risk management goes out the window as people invest money they can't afford to lose. Third, funding flows to projects based on their ability to generate excitement rather than their potential to create value. This dynamic has fueled the proliferation of low-quality projects throughout the cryptocurrency space. When money flows easily to anything labeled with blockchain buzzwords, the incentive structure shifts away from building real solutions. The result is a market flooded with projects that exist primarily to capitalize on trends rather than solve real problems. During the dotcom era, companies added .com to their names to boost valuations. Today, projects add blockchain, Web3, or decentralized to attract funding, often without delivering any meaningful innovation. This dilution of quality creates noise that makes it harder for investors to identify legitimate opportunities. It also undermines trust in the entire ecosystem. When too many projects fail, scam, or simply disappear, even genuinely innovative initiatives suffer from guilt by association. The current regulatory landscape for cryptocurrency is fragmented, inconsistent, and often reactive rather than proactive. Different jurisdictions apply conflicting rules, leaving projects and investors navigating legal gray areas. Some countries embrace cryptocurrency innovation, while others ban it entirely. Even within individual countries, different regulatory agencies often provide contradictory guidance. This regulatory uncertainty creates several problems. It discourages responsible institutional participation because major financial institutions can't invest in assets where the legal status remains unclear. It allows bad actors to exploit loopholes and operate in jurisdictions with weak oversight, and it prevents the development of standardized consumer protections that exist in traditional financial markets. Many cryptocurrency enthusiasts view regulation as the enemy of innovation, but this perspective misses a crucial point. Well-designed regulation doesn't stifle innovation. It enables it by creating a stable framework where legitimate businesses can operate with confidence. Traditional financial markets didn't mature despite regulation. They matured because of it. For cryptocurrency to evolve into a mature asset class, regulation needs to become more centralized in its principles, more consistent across jurisdictions, and focused on transparency, consumer protection, and accountability. This doesn't mean eliminating the innovative aspects of cryptocurrency or imposing unnecessary restrictions. It means creating clear rules that distinguish between legitimate projects and fraudulent schemes. Perhaps no issue threatens the long-term credibility of cryptocurrency markets more than the prevalence of scams, fraud, and outright theft. From elaborate Ponzi schemes disguised as investment opportunities to rug pulls where project teams disappear with investor funds, fraudulent activity has become disturbingly common in the cryptocurrency space. These scams take many forms: fake tokens that mimic legitimate projects, manipulated liquidity pools designed to trap unsuspecting traders, investment schemes that promise unrealistic returns, phishing attacks that steal private keys, exchange hacks that result in massive losses. The variety and sophistication of cryptocurrency fraud continues to evolve as quickly as the underlying technology. In mature financial markets, fraud is aggressively investigated and prosecuted. Regulatory agencies have clear authority, law enforcement has specialized expertise, and legal frameworks provide strong deterrence against criminal behavior. In cryptocurrency markets, enforcement remains fragmented and often ineffective. Many scammers operate with relative impunity, moving between jurisdictions and exploiting regulatory gaps. This enforcement deficit doesn't just harm individual victims, it undermines trust in the entire ecosystem. Every high-profile scam makes it harder for legitimate projects to attract users and investors. It reinforces negative perceptions about cryptocurrency among mainstream audiences and provides ammunition for critics who argue that the entire space is inherently fraudulent. For cryptocurrency to move forward as a mature financial system, scammers must be systematically removed from the ecosystem through aggressive prosecution and clear legal consequences. This requires coordination between regulatory agencies, law enforcement, and international authorities. It also requires the cryptocurrency community itself to stop tolerating fraudulent behavior and to actively support efforts to identify and eliminate bad actors. Looking at all these issues together, 5 core problems emerge that must be addressed before cryptocurrency can evolve into a mature and resilient market. These aren't minor tweaks or gradual improvements. They represent fundamental structural changes that will likely require significant disruption to achieve. First, markets must become deep and liquid enough to resist manipulation by individuals with large followings or significant capital. This means developing trading infrastructure that can absorb large orders without extreme price movements, attracting a broader base of participants with diverse motivations, and reducing the influence of social media on price discovery. Second, the balance between speculators and actual users needs to shift dramatically. Long-term users and builders must outweigh short-term traders. This requires developing applications and use cases that provide genuine utility independent of token price appreciation. It also means attracting participants who value the technology for what it can do, not just what it might be worth. Third, FOMO-driven capital misallocation must be replaced by education and transparency. Investors need better tools for evaluating projects, clearer disclosure requirements, and stronger incentives for due diligence. The current environment where marketing hype can attract more funding than technical innovation is unsustainable. Fourth, regulatory frameworks must become more consistent and comprehensive. This doesn't mean stifling innovation, but it does mean creating clear rules that provide certainty for legitimate businesses while eliminating safe havens for fraudulent ones. Regulatory coordination between jurisdictions is essential to prevent regulatory arbitrage. Fifth, accountability for fraudulent behavior must be dramatically strengthened. Scammers operating in cryptocurrency markets should face the same legal consequences as those operating in traditional financial markets. This requires better enforcement mechanisms, international cooperation, and specialized expertise within law enforcement agencies. History suggests that transformative technologies often require a painful reset before reaching full maturity. The dot-com crash was devastating for many investors and companies, but it was also cleansing. It forced markets to reassess value, reallocate capital more rationally, and focus on building sustainable businesses rather than just capturing market share. The companies and business models that survived the dot-com crash formed the foundation of today's digital economy. Amazon, which lost 94% of its value during the crash, emerged stronger and eventually became one of the world's most valuable companies. Google was founded in the aftermath of the crash and built its business model around sustainable revenue rather than speculative metrics. Cryptocurrency may require a similar reckoning. A market correction that eliminates speculative excess forces projects to focus on utility rather than hype, and attracts participants who understand and value the underlying technology rather than just its investment potential. Such a correction would be painful in the short term, but it could be essential for long-term success. Markets that survive this kind of stress test emerge with stronger foundations, more rational pricing mechanisms, and greater credibility among mainstream participants. This doesn't mean cryptocurrency is doomed to crash, but it does suggest that the current market structure is unsustainable. The speculation-driven, hype-fueled, manipulation-prone environment we see today cannot persist indefinitely. Either the market will mature gradually as the issues we've discussed are addressed systematically, or it will mature suddenly through a dramatic correction that forces rapid change. Despite all these challenges, the long-term opportunity for cryptocurrency remains extraordinary. The vision of decentralized financial systems that increase access, reduce costs, and eliminate single points of failure is still compelling. Blockchain technology can enhance transparency, automate complex agreements, and enable new forms of digital ownership. Digital assets can redefine how we think about money, property, and economic participation in an increasingly digital world. But these promises will only be realized once the current market immaturity is addressed. Speculation must give way to utility. Hype must be replaced by transparency. Manipulation must be eliminated through better market structure and regulation. And fraud must be aggressively prosecuted to restore trust. The path forward requires patience, discipline, and a willingness to prioritize long-term value creation over short-term price appreciation. It requires building real applications that solve real problems, rather than just creating new ways to speculate on token prices. It requires education, both for investors who need to better understand what they're buying, and for regulators who need to create appropriate oversight frameworks. Most importantly, it requires acknowledging that cryptocurrency is still in its early stages, not in terms of hype and attention, but in terms of maturity and sustainability. The road ahead will include volatility, regulation, consolidation, and likely some painful corrections. But if the cryptocurrency ecosystem can learn from the lessons of previous technology bubbles, embrace accountability, and focus on creating genuine value, it has the potential to evolve into the resilient financial system its early vision promised. The parallels with the dot-com era are striking and instructive. Just as the internet needed to crash before it could truly change the world, cryptocurrency may need to experience its own reckoning. The speculation needs to be cleared away, the infrastructure needs to be strengthened, and the focus needs to shift from getting rich quick to building lasting value. When that transformation happens, what remains may finally be worth building upon. The cryptocurrency revolution isn't over, it's just getting started. But first, it needs to grow up. The question isn't whether cryptocurrency will mature, but how painful that maturation process will be, and whether current participants are prepared for the transformation that's coming. The opportunities are real, the technology is powerful, and the vision is still compelling. But realizing that potential requires moving beyond the current casino-like environment toward something more sustainable, transparent, and trustworthy. That transition won't happen overnight, and it won't happen without disruption. But it's the necessary next step in cryptocurrency's evolution from speculative experiment to mature financial system. The choice facing the cryptocurrency community is clear. Evolve voluntarily through systematic improvement and self-regulation, or evolve involuntarily through market forces and external pressure. Either way, change is coming. The only question is whether we'll guide that change or be swept along by it. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.